Bonjour. My name is Isabelle Bibet-Kalinyak. I am a lawyer and partner in the National Healthcare Practice Group of the law firm of McDonald Hopkins and the ophthalmology specialist at the firm. As a member of the American Academy of Ophthalmology, ASCRS, and MGMA, I regularly attend and speak at your meetings on various topics. In my daily practice, I represent and counsel physicians and physician groups about life cycle management events and matters such as mergers and acquisitions or physician contracting, as well as about healthcare compliance, including fraud and abuse issues. As a first-generation immigrant from France, and after having worked for over 17 years in the healthcare industry in various settings, I have a unique perspective on the U.S. healthcare system. My co-presenter today is an experienced investment banker, Patrick Krause.
Hello, and thank you for taking a few moments to join us. My name is Patrick Krause, San Francisco-based Managing Director in Stifel's Healthcare Services Investment Banking Group. Over the past 20 years, I've spent my career at the intersection of finance and healthcare. First as a consultant at Deloitte, helping solve strategic problems for leading healthcare companies across a wide range of industry subsectors, from commercial payers like United Healthcare to integrated businesses like Kaiser Permanente. I've gained a wealth of experience. As a banker, I've leveraged this experience to help founders, owners, physicians, and their partners evaluate and pursue strategic alternatives for the businesses that they've built, and have helped numerous groups across several specialties form great partnerships with private equity groups. I'm looking forward to sharing the insights I've gleaned through these deals alongside Isabelle as we present the materials today. I hope you find them helpful and informative. If any questions arise, please do not hesitate to reach out to either Isabelle or myself via the contact information provided.
Patrick and I thank you very much for taking the time to join us today to discuss the fascinating topic of private equity investments in the ophthalmology space. Opportunity or illusion? You can decide at the end of our presentation. We have prepared some slides to guide this conversation, beginning with laying out your strategic options besides private equity, followed by an overview of private equity investments across the healthcare space. Patrick will then introduce the mechanics involved in evaluating your practice for a potential private equity deal, and we will then highlight important process and deal structure considerations before we can show you the money. The exhibits section included in your slide deck contains specific examples and other valuable information. We have an ambitious agenda, but our main objectives today are threefold. At the end of this session, you should understand why and how to engage your partners of various age about growth and your practice strategic fit for private equity or other options. You should also know the pros and cons associated with a private equity deal. And finally, you should be able to implement some concrete action items to best position your practice for sustainable growth with or without private equity. In other words, you should be able to answer the question, opportunity or illusion?
In Section 2, we'll talk about the various strategic alternatives available to practices. As you begin to familiarize yourself with the world of private equity, it'll be important to understand what your key objectives are, both as a practice and as individuals. The next slide is really geared towards helping you expand and understand why you might consider a partnership with private equity. It's important to think about what you want to do. Do you want to grow? Do you want to manage succession planning for a practice with some older physicians nearing retirement age? Would you like to find a thought partner that can help you grow the practice, connect you with commercial payers, help expand the ancillary services you offer to your patients, be it through a lab, a surgery center, or the expansion of your retail medical practice? Think about what could be your most likely exit strategy. Would you sell to partners, to local competitors, others? What risks do you face? This is a particularly poignant question, as many practices have faced real challenges with the pandemic and their ability to get patients in. Anecdotally, we've seen many specialties rebound, particularly those that have or provide higher acuity services. But I think the pandemic has posed real challenges for practices, and being part of a larger group could provide some safety and security that might be lacking for smaller practices. Think about why you might want to do this. Is it the right time? What would a great outcome look like? What's your risk tolerance? What would you like to do after this transaction? And what roles might you want to play with a private equity group? Answers to these questions will position you well to have detailed, honest conversations with prospective partners and inform you on what particular alternatives you might want to explore. And I think after some introspection, the next step in evaluating a private equity partnership would really be to lay the foundation in the form of a plan for the business. Spend some time thinking about how you might want to grow the business, or if you want to grow the business. What's important to you? Do you want to maintain the status quo? Do you want to grow into new markets, offer new products or services, de novo a new location, spend more time with patients? A thoughtful business plan will enable you to have more informed, more honest conversations with potential partners and position you to capture value in your business by articulating the best things about it, positioning risks appropriately, and laying out a compelling case for growth. Nothing gets private equity groups more excited than the prospect of investing in an engaged, growing practice. And by spending time up front, really laying out your business plan and the growth opportunities available to it will generate significant value for you as you consider a possible transaction. Moving on to slide 10, we can start to look at some of the strategic alternatives available to various practices. Depending on your goals, a host of alternatives are available. I'll walk through each of the items here on slide 10, but I will note, and we've shaded majority sale to financial buyers as the most likely scenario, and one that many of the subsequent slides will be keyed off of. But the first item here is status quo. And if you're like most of the groups that Isabelle and I talk to, status quo looks pretty good. You've worked hard to build a great practice. You've got growing patient volumes, engaged partners. You're happy, and the world looks good. And really, not much changes if you can continue to pursue the course charted today. But chances are good, if you're tuning in to this presentation, the status quo may not get you everything you want in terms of growth, in terms of liquidity. So we can move on to discuss some of the other alternatives. The first is a debt recapitalization, which you would basically go to a lending group and borrow money. You could use that money to pay yourself a dividend and then service the debt through the cash flows of the business. That's great in that it provides you some liquidity. There's no dilution. You retain control of the practice, but it could be cumbersome to manage the practice with debt on it. There could be some personal liability associated with it. And generally speaking, this is an option that's really only available to very large practices. The next alternative would be a minority recapitalization. And in this potential scenario, you'd sell a smaller portion of the practice to a private equity investor. Some private equity investors are willing to do deals like this, but the vast majority are interested in acquiring 51% or more of the business. In a minority recapitalization, you'd retain control of the practice. You'd get some liquidity. You'd also get to bring on a value-add partner in the form of a private equity group. However, you'd experience some dilution your valuation might not be as high as it would be on a majority sale of the business, and it could hamper, future options for the practice. The most common alternative that we see groups explore would be the majority sale to a third-party investor, whether that's strategic or private equity backed, and we'll get to the difference between those two groups on the next slide. You would sell between 51 and 80% of the equity in your business, potentially up to 100% to an outside investor. And here, the benefits would be significant liquidity. You'd get to bring on a value add partner who will have additional capital earmarked for growth. But you do lose some control over your operations. Now I'll pause here and note that while you do lose some control, no private equity group will ever tell you how to practice medicine, whether it's from the number of patients that you need to see to the type of sutures that you would need to use. Private equity groups are focused on investing in leading practices, with the assumption being that you, far more than they, know how to practice medicine efficiently, provide high quality care to your patients, and run a well-organized practice. Private equity is great at helping set up back office facilities, but they will not tell you how to practice medicine. So important note there as it relates to control. While you may not own a controlling percentage of the business anymore, private equity groups will never tell you how to practice medicine. And then the last item here is my majority sale to a strategic buyer. It's just a little nuance between financial and strategic. Strategic implies that there's already an investment in the space, as opposed to a private equity group's first investment in a sector, which is a great transition to slide 11. We break down the definition of strategic and financial buyer and a little bit more granularity. Again, nuances here. A strategic buyer could be owned by a private equity group, or a private equity group could be making their first investment in the space. But really, a strategic buyer is an existing physician group that's similar or larger, and a couple examples could be KKR's investment in Envision, or Blackstone's investment in Team Health. In ophthalmology, Harvest Partners owns ESP, Shore owns iSouth. Many examples there. They could be public companies, they could be surgery centers, hospitals, insurance companies. Notably, Optum, which is owned by United Healthcare, has been a very active acquirer of physician practices. We'll call those strategic buyers. You'll hear that term throughout these materials. Also may hear financial buyer. Really what that means is private equity group. It could be a family office as well, or just other business owners, but differentiated in that they do not already have an asset in the space. Moving on to slide 12, I'll add one more wrinkle to the equation here. So now that you've thought a little bit about why you might want to partner with a private equity group, you've laid out a plan for your business, understand the different alternatives available, and are contemplating a sale of your practice or partnership, it's important to talk about whether you'd want to be a platform, meaning the first investment for a private equity group in the space, or an add-on. Partner with a larger group. It's either independently owned, publicly traded, or most likely already owned by a private equity group. And there are definite benefits and drawbacks to either being a platform investment or an add-on investment. This will really tie into what you're trying to accomplish as a group of physicians and as a practice. So I'll walk through the various pros and cons here. As a platform, you are going to be the first investment for a private equity group. And in this scenario, you will retain leadership roles in the practice. It'll be up to you to drive strategy and growth alongside your private equity partner. There's a real premium, too, paid for those first investments in the space. Groups are willing to pay up to get access to a sub-vertical in healthcare that they're not already invested in, and platforms, because they tend to be larger, tend to command premium valuations compared to add-ons. Notably, platform transactions can take longer to complete because of the fact that it is the first investment. More comprehensive diligence is going to be performed. There may be a longer negotiation period for the purchase agreement and ancillary legal documents. You're really creating the template for subsequent acquisitions in the future. And you're driving the bus going forward. That could also be in the benefits category as well. But for some physicians that are nearing the end of their careers, the thought of driving 100% growth for the next 5 years may seem daunting. And as such, a platform sale might not be the right alternative if many physician partners are in the same bucket. Compare a platform sale to an add-on sale to an existing platform. You would be selling your ophthalmology practice to a larger group that has already got a private equity partner in place. And there, the benefits are almost flipped from a platform sale. So you have the ability to hand the reins over to a private equity partner. It's potentially a shorter diligence process. They know the industry. They've got checklists and templates built already. And you'd be likely to negotiate purchase agreements and supporting documents more quickly. Now, conversely, you're going to have slightly less control over the strategy and operations of the business. And you may not get the same valuation you would as a platform. However, I'll throw in a caveat there. This is highly contextual. So if you are the first or second acquisition for a platform, you can get a valuation that's very similar to theirs. Nothing's more important than getting the first deal done, than getting the second done, and getting some traction in the market. It's also very relevant where you are in the market. If you can fill in strategic gaps on the map, add expertise or service offerings that the platform doesn't have, you can command a similar value to the platform. So really, the desired transaction type here, platform versus add-on, it can influence how an advisor might position your business. It's important to have a feeling for which direction you'd want to go and have those discussions early on with your advisor so that they can position the business in the best way to capture value and to get you the most of what you want. I will conclude by saying a well-run process can generate both platform and add-on offers, which would allow you to compare structures and, again, make an informed decision. I'll wrap up this section by saying, take time. There's going to be a wealth of opportunities for well-run practices well into the future. Know what you want. Ask the key questions. Build the consensus among your partners prior to having conversations with private equity. And with the right advisor, you'd be well positioned to approach the market and evaluate what I'm sure would be a host of attractive alternatives for your practice.
Ophthalmology represents a very attractive opportunity for private equity investors. But what is private equity? A private equity fund is usually made of wealthy investors that pool together to invest in highly profitable companies or industries for a predefined period of time of usually 7 to 10 years. During its lifespan, the fund will acquire equity in multiple companies for the purpose of growth and profitability, through aggregation and debt financing before reselling these companies for a target return of 18 to 24% on average within a 3 to 5 year window. It is not a Ponzi scheme, but fairly simple math. The fund has access to a lot of capital at cheap rates. It can therefore fund the growth of a practice faster and cheaper than its owners can. In addition, by aggregating multiple practices, the fund can create what we call enterprise value as depicted on this slide. In this example, Practice X and Practice Y each generate approximately $3 million of EBITDA and command multiples in the 5 times EBITDA range. Their individual enterprise value is therefore approximately $15 million, 3 times 5, or between the two of them, $30 million total. After merging the two practices, the new entity combining both practices may command a multiple of 8 times the total EBITDA of $6 million, i.e. $48 million. This illustrates how a fund can create additional enterprise value, and in this example, an extra $18 million by merging and leveraging the value of the two practices. At this point, you are probably wondering why partner with private equity. What's in it for me? Well, there are some very, very meaningful advantages in partnering with private equity. But you first have to accept private equity as a value-adding partner. It's not the Messiah, nor the devil. It's not just a lender. It is a new partner for your practice. The advantages can basically be divided in two groups. One group includes all the financial benefits you can derive from private equity, and the other group includes all the operational benefits. In the end, these two groups overlap, and that's how enterprise value that we just discussed is created. The first advantage private equity can bring to the table is experience and know-how in the vision care space. We have a growing number of funds already invested in ophthalmology today and doing very well. Names like Audax, Alpine Investors, Shore Capital Partners, etc. They are familiar with the risks and opportunities of operating multi-site businesses, and they have the playbook. They want to apply this playbook to your practice while you focus and concentrate on providing great care to your patients. Although experience in the vision care space is important, I don't think it is the most important advantage that private equity brings to the table. Private equity investors specialized in the healthcare business have the expertise to scale your business by multiplying the number of locations because they know how to build this, develop this, including recruiting physicians and retaining physicians by meaningful incentives. They will also give you access to additional resources such as key personnel, practice managers. They also have the payer relationships and even potential referral relationships depending on your subspecialty. This basically means that you are not going to be the guinea pig. The third advantage is money. Most funds have deep pools of capital to fund future opportunities for your practice. The money available to private equity investors is in form of cash, but they also have access to a very strong network of lenders and debt providers at very attractive rates. The advantage for you and your partners is access to vast amounts of capital without personal risk for your wealth. The fifth advantage is private equity's ability to align incentives for everybody around the table. You will be incentivized to continue growth for your practice through the rolled over equity that you are expected to retain. But the private equity fund will also create some option pools for current non-partner physicians as a recruitment and retention tool. This type of options pool can be created at the time of a transaction or later as the practice matures. Lastly, And although not mentioned on this slide, one of the key advantages is the big liquidity event that each partner in the practice will experience at the time of closing. A private equity transaction is a unique opportunity to turn into liquidity all the hard work that you have put in throughout the years. And if structured properly, this liquidity event can have some significant tax advantages for you and your partners. Private equity groups are not monolithics in terms of capabilities and management styles. There's no right or wrong out there, but you need to find the right fit through a very rigorous selection process. This is on you. In this slide, I want to bring to the forefront some of the quantitative operational benefits that you should expect by choosing the right partner. By now, you have probably all received some phone calls of potential buyers, but I cannot overstate the importance of speaking to several groups so that not only you get the best deal for your practice, but you are also able to find the best partner. If your respective philosophies align, you can expect the potential benefits described in this slide. First, the ability to extend patient care and capabilities, either by adding locations, new services, and new service providers. Secondly, you can expect an acceleration of growth. Buckle that seatbelt. This typically manifests itself by the acquisition of existing practices, funding the startup costs of brand new locations, as well as investments in marketing offerings. All these growth strategies will be backed by the private equity fund and not put at risk your personal wealth. In addition, the financial support of private equity funds can be a very welcome relief during periods of uncertainty such as COVID-19. Patrick, my colleagues, and I have all received the phone calls from our clients thanking us for explaining the benefits of private equity since the onset of COVID-19. In addition, one of the most understated benefits of private equity is the creation of new roles for physicians who are interested in leadership roles. Whether on the clinical side with roles such as chief medical officer or on the strategic side, these types of roles only exist thanks to scale. These roles can be a nice segue prior to retirement if you want to diminish the time you spend in surgery or on call. In terms of infrastructure and administration, private equity groups also offer an unmatched level of back office capabilities. We are talking about billing, collections, compliance, marketing, legal, recruitment, onboarding, etc., etc. You can now focus on your patients and leave the administration to the private equity fund. But going back to my introductory comments, you will only be able to monetize your equity sweat, all the times and efforts you have invested year after year in your practice to the fullest extent if you have selected the right partner and are able to leverage these benefits to the fullest extent. Now that we have discussed some of the quantitative operational benefits you can derive from private equity by choosing the right partner, let's pivot to some additional considerations. Let me first start by dispelling some myths. Your private equity partner is not going to tell you how to practice medicine. It's not going to tell you how many patients to see. It's not going to terminate providers in the middle of a transaction or after the transaction. It's not going to disincentivize you or demotivate you or your employees. It's not going to force anything upon you. And it's not going to over leverage your business and run you into bankruptcy. These are all myths, and it's time we dispel them for good. I can say this with relative certainty because unless you do this on your own without a good law firm or an experienced investment banker, we are not going to let you enter into a transaction with a private equity firm that is not a good fit for your practice or is financially unstable. This is part of the bargain you get by hiring the right team for this transaction. In the end, the top 6 factors are as follows. It's all about culture and fit. Can you see yourself sitting for hours in a meeting discussing practice issues? Talk to other physicians. It is the best way to find out what type of culture that private equity fund has and whether it matches with your own practice culture. Second, does the fund have industry expertise within vision care and at least within healthcare? Experience in ophthalmology is a great asset, but is not insurmountable, as long as the private equity fund has expertise in healthcare and operating experts on staff. After all, you are the ultimate expert in vision care. You can leverage that position. The third consideration relates to your goals. What level of autonomy do you desire? Do you want to step back and go golfing every night after practice? Or do you want to be involved in management and strategy? That's up to you, and you can ensure that you select the appropriate fund to meet your goals. The level of autonomy you desire going forward will be directly related to the role you will take in the practice. The 5th item on this list is compensation. All providers will be expected to move to a productivity-based compensation model many of you are already accustomed to. However, although you will retain some level of equity, you will not be receiving the same level of compensation as take-home pay, all bonuses included, and all distributions included. So you should prepare for what number is your bottom line so that you are prepared to walk away if that is not what you can get. But be realistic there, and that's where we can help you. Your investment banking team and your legal team will know what's market. Last but not least is the philosophy on patient care. This is the heart of your practice. This is why patients come to your practice. This is why your colleagues refer their patients to your practice. So make sure you select the appropriate fund matching your own philosophy and not the reverse. Now that you understand the key factors that are so important in selecting the right partner, you can also start to weigh the pros and cons of each options. We have summarized these pros and cons in this slide, and you can review them at your own convenience. But I want to highlight a few items here. A key advantage of private equity partnership is the ability to double dip. You will first experience a liquidity event at the time of closing, but since you will retain equity and there is likely to be a second event, you will also benefit from the leverage and expertise of a private equity partnership and maximize value in the future. You will have to roll over some equity, but you will have flexibility in the amount of rollover equity that you decide to reinvest in the practice. The third point I want to make is about the loss of autonomy. While real, the loss of autonomy and control is only about the business side. The private equity partner is not going to interfere much at all, if any, with the clinical operations of your practice. Because each pros and cons listed in this slide means something different for each of you. If you already know that this is for you, you next need to put yourself in the shoes of your partners to be able to engage them in meaningful discussions and make sure they are on board. I am going to make this easy for you and explain how physicians at different stages of their careers will realize different benefits when partnering with a private equity group. This table illustrates the benefits, the drawbacks, as well as the likely economic considerations that aging partners, existing younger partners, as well as potential rising partners will experience when considering partnering with a private equity group. This is essentially your roadmap to convincing your partners that private equity is also for them, regardless of their age or status in the practice. I will focus on the existing partners that are not yet of retirement age because they are often the ones you need to convince. Although the economic benefits are palpable for the younger physicians, merely by the fact that they are basically receiving credit for the full value of the practice that they have not created, in addition to receiving a liquidity event and rolled over equity from the transaction. These benefits are often overshadowed by a sense of loss of control over the practice and that the practice is basically stolen under them. The ultimate remedy for this is patience and data. Show them the money, or let the experts show them the money because it gets complicated, and involve them in the process early on. Going back to slide 9, the case for growth that Patrick described earlier. Unless you are rolling in cash or desirous to finance debt through personal guarantees, private equity or some form of partnership is the only way not only for growth, but for maintaining the same level of revenue because your expenses are continuously growing, the payer reimbursements are decreasing, and competition is only going to become sharper. It is imperative you get their buy-in before you move into a transaction. Your investment banking team and your legal team can help you to get there. I want to pivot a minute to what is on everybody's mind, COVID-19. 9 months into the pandemic, we are able to draw some lessons. Yes, the pandemic has altered the market. However, deals are still getting done today. Back in March, at the time of the lockdown, 2 things happened. First, the phone stopped ringing. And second, the deals that were in process were put on hold. But this did not last very long, and the market adjusted nicely to the new reality. We saw relatively fewer deals, and certain specialties were more affected than others. Hospital-based specialties such as anesthesia took the brunt of the hit, at least at the beginning. As COVID became the new normal, practices that perform higher acuity procedures saw the highest rebound in terms of patient volume. In addition, practices with ownership in ambulatory surgical centers or practices with contracts with ambulatory surgical centers were able to rebound faster because they were not dependent on the lockdown at the hospital level. Ophthalmology, as you all know, was hit hard. But the resilience of our healthcare providers in this system really shined through. Who thought we would use telehealth and ophthalmology before the pandemic? The combination of ambulatory surgical centers ownership and the strategic use of telehealth solution altered the fatal course of numerous practices. And the private equity market responded very favorably to these trends. Valuations for well-run businesses remained very strong. Instead of going away and sitting on their cash, buyers started to focus on risk allocation to protect against downside cases. The private equity buyers basically said, okay, we understand this pandemic is not going away and we still like healthcare. However, we need some protection. Help us partner with you. This resulted in alternative deal structures such as earnouts and seller notes, which fairly rarely saw before the pandemic. An earnout provision basically puts into escrow a portion of the proceeds you would otherwise have received upfront at the close of a transaction. The funds are then released when the practice hits some milestones that are predefined into the transaction documents. Seller notes are basically an IOU from the buyer, where the practice owners agree to receive a part of a consideration at a future point in time in exchange of a fairly attractive interest rate. These notes typically mature within 1 to 3 years. In the most sophisticated deals, buyers used a combination of earnouts and seller notes to protect themselves but still get the deal done. Where we stand today, we see these trends as having a positive impact on the EBITDA that practice owners can derive from entering into a deal with private equity investors as depicted in this slide. So what are the key takeaways where we stand today, 9 months into the pandemic? The good news is that COVID-19 has impacted every practice in this country, regardless of specialty or location. Your response and your resilience can tell a story about the culture of your practice. Please keep track of all these efforts so that you can better tell that story and can measure and validate your costs to COVID-19. At this stage, we are seeing a very pragmatic response from the market, and there's very little value in running what-if scenarios in response to the pandemic. We know it's here. Just be able to demonstrate you are on track to recovery. Now, none of us live in La La Land, and I think we all can acknowledge that 2020 is going to be a challenging year for most practices. But the market understands this, and private equity investors are not moving away from healthcare. Investors are, however, going to be more choosy, and this will directly manifest during the due diligence process. You can demonstrate the quality of your management team by documenting the remedial measures that you have taken during the pandemic, as well as compliance in terms of risk management. Your management team, perhaps with the help of your current consultants or an investment banking advisory firm, needs to track new performance indicators focused on post-recovery performance. Understanding the key changes in customer patterns and referral patterns is paramount as we expect this pandemic to last several more months. If you have not already done so, we recommend that you start focusing on 2021 and beyond and plan for multiple case scenarios. All in all, we think that ophthalmology and optometry practices will remain attractive investments for private equity investors in 2021. Before getting into valuation mechanics, Patrick and I wanted to show you a snapshot of private equity investment in the healthcare system as a whole, as depicted in slide number 22. All physician practice management specialties remained very attractive investments for private equity. Both the activity level and the multiples remained high. In terms of trends, telehealth across most specialties definitely took the grand prize. Private equity most definitely considers vision care a very attractive segment. The emergence of private equity investments in ophthalmology can be traced back to 2016. Many of you will remember the excitement around the New Orleans conference in 2016. I was there and actually thought that the market was going to quickly take off in the same fashion dermatology did. But ophthalmology did not follow dermatology. Although some deals were done and some major platforms emerged, the ophthalmology remained largely skeptical of private equity. By the time we met in Chicago in 2017, some people were talking about Ponzi schemes, the lack of incentives for practice owners, especially for younger physicians. I think we are past that high level of negativity as illustrated by some major deals in the Midwest, notably by Alpine Investors, a San Francisco-based private equity firm that created Midwest Vision Partners, an umbrella over Northeast Ohio Surgeons and Ohio Eye Care Consultants, which has since expanded into Michigan. This next slide depicts select private equity investments in ophthalmology and clearly shows that investments are spreading all across the U.S.
In Section 4 of these materials, provide an overview of the valuation mechanics used when determining the value of a practice. I'll preface all of these remarks by saying that valuation, while informed by numbers, blends a bit of art and a bit of science. Do our best to apply academic rigor in all valuation exercises, and we'll talk through 4 of the most commonly accepted valuation methodologies here on slide 26. But recognize that these methodologies are highly dependent on the underlying data. As we've discussed in previous sections, it's very important to make sure that you have well-articulated business plan, growth projections, and that the numbers are as clean as you can make them as a practice. We're diving right in with the first valuation methodology, precedent transactions. This looks at how acquirers have valued similar businesses, whether size or industry, in recent change of control transactions. These metrics can be discounted when appropriate based on size or risk associated with the business. The best analogy I can offer here is home sale comps. If you've sold a home, you'll know that you look at the sale price for similar homes when determining the value of the home that you're selling. This is a good analogy. The next valuation methodology that's commonly employed by both investment bankers helping you in the sale process, as well as private equity investors, is a discounted cash flow analysis. You might hear this referred to as a DCF as well. And this really looks at the intrinsic value of the business, particularly the cash it's able to generate it over time, discounted back to present terms. Here, it's thinking of the business as an annuity that is bought and the cash flows that it's able to generate. This is important for private equity groups to look at, as it also allows them to gauge the amount of leverage they might be able to put on a business, which governs the return that they're able to generate on any investment. Again, it's highly dependent on the forward-looking prospects of the business and the cash flows it's able to generate. We'll walk through some examples of this and other valuation methodologies on the coming slides. The next valuation methodology is a leveraged buyout analysis. Here, this is how private equity groups will value a business. And again, going back to the real estate market, the best analogy I have here is using a mortgage to buy a home. Private equity groups will purchase a business with the assistance of some debt. Note that this debt is on the company, and you will have no recourse associated with that debt. They'll model out the performance of the business, look at the debt service, and make a determination as to what they could pay for a business based on several investment parameters that they have and are committed to providing back to their investors, their LPs. The last valuation methodology that we commonly use when valuing a business is comparable companies. So this looks at how public markets value publicly traded businesses. And here too, we'll adjust valuations based on size, liquidity, and what it would cost to purchase the entire publicly traded company. We blend all of these analyses together to come up with a range of potential valuation outcomes. One thing that I frequently get asked, and it's a great question, but is what is the value of my practice? And I always answer that question in a range. So I'd say it's between $100 and $120 million, or 10 to 12 times $10 million in EBITDA. It's very common to take all of these methodologies into consideration and provide a range of potential outcomes for valuation. It may seem like a hedge, but it is, in fact, perhaps more honest to provide a range of potential outcomes than to say definitively your business is worth $110 million. Moving on to slide 27, let's continue our discussion of valuation mechanics. And one nuance to valuing physician groups is the creation of a fairly common financial term in their practice, which is EBITDA, or earnings before interest, taxes, depreciation, and amortization. It's typically used by bankers and private equity groups as a proxy for cash flows, or the cash that you're able to generate from operations. Well, it's not a GAAP term. You're not likely noting your EBITDA on your internal profit and loss statements. As bankers, we'll help you determine what that EBITDA number is, and most importantly, how it applies to valuation. So again, if we're looking at comparable company analysis, we'll see that the market for great ophthalmology practices doing $5 million of EBITDA is quoted as being 9 to 10 times, with the implication being that the value of the business would be 5 times 9, 45, or 5 times 10, 50, 45 to $50 million. So it's important to get your arms around EBITDA. Most physician practices are typically run as partnerships, and as such, distribute the majority of income to the partners at year end, meaning there's really no cash left in the business. Our job as advisors would be to create EBITDA by looking at your profit and loss statement and normalizing that with the cost associated with selling partners working as employed physicians going forward. And in doing so, you're able to create EBITDA, marketable EBITDA for a practice, which private equity investors, again, will use to value your business. I have a note in these slides because we've been working with some retina groups lately that the market for employed retina physicians is somewhere between 30 to 50% of collections less drug cost. You can certainly make those comments more relevant to general ophthalmology practices, but directionally, that's correct. If you think about trade-offs, partner-physician comp can be one of the largest expenses of a practice, and as we've discussed, will have a direct impact on valuation. There is a temptation to take less compensation going forward. That's going to allow you to create more EBITDA and monetize more of your stake in a practice at the time of sale. And that's important to think about. There's tax implications there, as the proceeds from a sale are generally taxed at a capital gains rate, while compensation is taxed at an ordinary income rate. But private equity groups have become adept at doing this analysis, and to make sure that post-deal incentives are aligned, no private equity group is going to allow you to sell down all of your compensation. They're going to require that you take a market salary so that you show up and are motivated to work hard every day post-sale. Again, I know we've mentioned this in other sections, but it's a human capital business. You need to make sure that incentives are aligned, and having a production-based market clearing salary going forward is one of the ways that private equity groups can make sure that physicians remain motivated to work hard and grow the practice post-sale. You see a little exhibit here to the right-hand side of slide 27, which shows the potential differences in marketable EBITDA based on the percentage of collections physicians are willing to take and the corresponding valuations for the business. And you'll note that there's an inverse relationship between the amount of go-forward compensation and the value for the business. So part of the magic that we can weave as advisors is to help you think through what comp you'd be willing to work for and what EBITDA we would be able to market. Moving on to slide 28, this is where we see all those pieces come together. So now that we've determined what comp physicians would like to work for and what EBITDA is, we can see the math that a private equity group would do when calculating the valuation of the business. I won't walk through these examples in detail. They're there as an illustration. The point that I want to make on this slide, and while we've been talking about EBITDA on the last slide, is that you could use multiple comparable methodologies to evaluate the valuation of a physician practice. Some groups, I would say most groups, look at an enterprise value to EBITDA multiple, right? So they will take the EBITDA that we've determined a practice to generate and apply a multiple of that to get to evaluation of the business. There are fewer cases, and this is an older model that we've seen in more hospital-based specialties, where they would look at the earnings before partner comp, right, and use that as the proxy for cash flows as opposed to EBITDA, and apply a multiple on that to come up with an enterprise value. I would say it will be very unlikely that you were to see a situation like that, but in the sake of completeness, I wanted to mention that there are multiple different ways for comparable methodologies to be applied to your practice when determining valuation. I'll guide you to focus on the EBITDA example because that is the far more likely valuation scenario for your practice. Moving on to slide 29, I'll continue our discussion of EBITDA. Again, it's all about the EBITDA. If you are in a position to go forward in a transaction, you'll probably be sick of hearing the term over time because bankers and private equity alike tend to fixate on it. But really, it is important, and it is important to understand adjustments that you can make to that particular number. Again, the goal is to put the best possible spin on the practice, and there are adjustments that you can make to increase EBITDA that is shown to investors. We've talked extensively about owner's comp, but you can also bake in potential adjustments for one-time expenditures related to legal. Certainly bankers' fees would be an EBITDA adjustment, as well as anything else that speaks to the normal course practice of a business. You could adjust in or out expenses that reflect the business operating under optimal circumstances to come up with an adjusted EBITDA number, right? Here too, and these adjustments would flow throughout. You could potentially position new providers, new locations, new services coming online, again with the goal of showing the best possible EBITDA number that you could get for the practice. Here, I would caution you and say that adjustments made to EBITDA do need to be credible. Private equity will go through an extensive amount of diligence and often fights back pretty hard on these adjustments. So what I always like to tell my clients is strive for aggressive but credible. Nothing hurts the positioning of the business and the process more than overly aggressive adjustments to the financials that really can't be justified or substantiated. You lose a lot of leverage in conversations. So it behooves you to be thoughtful when putting these adjustments together. Now, thinking about what does drive value, and I'll transition here to slide 30. We've laid out what we think some of the key drivers of value are, be broken down into three big buckets. Right? So rapid growth, efficient business model, your unique position to capture market share or gain access to a large market, and your ability to recognize revenue or operating efficiencies in the business. Good team, good market opportunity, providing the foundation for future acquisition opportunities, best practices. All of these things can create value for the business. And it really underscores the importance of correctly positioning the business and the materials that you put together prior to approaching private equity groups. So really going back to that theme of preparation, spend time thinking about what makes your practice good, and then work with your advisor to tell a quantitative and qualitative story that is really woven together by these items: the team, the expertise, the position in the market, the ability to reach more patients, the ability to offer new or extended offerings or capabilities. Articulating those and making sure that you have the numbers to support them will drive value in a process. Another factor that will drive value in a practice, and this is perhaps intuitive, but bears mention, is scale, right? So the larger you become as a practice, the more offerings you have, the more locations you have, the greater your scale. The larger, all things being equal, you could reasonably expect your valuation to be. So smaller practices can support less debt, are relatively more common, have relatively less negotiating power with commercial payers, and as such will not get the same valuation as larger, more integrated platforms. So as you think about your practice, one exercise I would give you would be think about where you're at in terms of scale, and whether you'd be willing to invest time and resources to growing the footprint of your practice, its capabilities, over a geography or geographies. As you'll see, that the larger you get, the more ancillaries you control, the better positioned you are to have conversations with commercial payers about rate improvement because you're the only game in town. The higher your expected valuation could be. And again, things to think about in terms of valuation, but also importantly, the strategy for your practice as you chart the course.
Thank you very much, Patrick, for explaining the valuation mechanics. Let's now turn to process considerations. Slide number 33, the process considerations. There are many ways to approach the market. We can initiate a broad process, a targeted auction, or a serial approach, or any combination of the above, all based on your unique goals and particular facts and circumstances. Each approach has its pros and cons. If your goal is to attract as many offers as possible and get the most competitive deal, the broad process is your best bet. Your investment banking firm and your legal advisors will assist you in selecting the process that best fits your needs and time frame. The most common approach is the broad process. However, this does not preclude conducting separate targeted discussions with specific investors or platforms that you already know or have already been contacted by, so as to keep the process going. This is particularly true in ophthalmology at this stage in the market. I want to quickly mention that although your confidential information will be distributed more broadly under the broad process, this is mitigated by the negotiation of a tight non-disclosure agreement with each party that will receive your confidential information. Your investment banker and your legal team will also ensure that only potential reputable investors are included in the dissemination list. Your investment banking firm and your legal advisors will each have specific roles in the process. An experienced team will ensure that we keep the momentum without sacrificing quality and return on investment. You should anticipate 3 main deal phases: preparation, marketing, and deal execution. These 3 phases are not perfectly linear, and some elements of each phase will overlap with the next one. You should be prepared to dedicate a fairly significant amount of time during the preparation phase. In order to solidify all aspects of the marketing strategy, your investment banking team will need your full cooperation to prepare the confidential information memorandum that will go out to the market. During this phase, you will also contract with an independent third party in order to procure a quality of earnings audit. This investment of approximately $50,000 to $70,000 will enable the investment banking team to create rigorous financial models that can be presented to the potential buyers. As completion of the marketing materials nears, the investment banking team will prepare you for buyer visits. In order to minimize disruption in your practice, we recommend that the preparation phase be kept covert and that you select one or a couple individuals to work with the investment banking team. Your accountant or accounting firm will also play a key role in this phase. For additional details about the process, please refer to slide number 37, which provides a visual illustration of the various steps. The time frame to complete a full process varies with each transaction and each specialty. However, you should expect approximately 6 months. It is, of course, possible to speed up the process, but the key variables remain the practice fundamentals and any issues unveiled during the deal due diligence process, whether from a business or legal standpoint. Please also understand that some variables are outside of your control, such as the strength, the style, and the experience of your potential buyer. When it's all said and done, you should expect approximately 1 year to complete the deal and effectuate integration. Based on what Patrick and I have described so far, it should be evident by now that the quality and the experience of your advisory firm and legal team are paramount. Although some of you may decide to forego the use of an investment banking firm, a choice that will leave you vulnerable to the very intense and skilled private equity investors. You will need to assess whether your current legal advisors, your day-to-day attorneys, are capable of handling a transaction of this type. Many small or local law firms are ill-equipped to deal with the sophisticated attorneys from the private equity investors. Your local attorney, and for that matter, your current accountant, may also be conflicted because they may lose you as a client once the transaction is completed. The investors will likely bring in their own accounting and legal advisors for the future. Slide number 36 illustrates all the steps in which your legal advisor for this transaction will be involved. Please note that private equity investors are out there actively seeking businesses to purchase outside of a competitive process. If they can get you hooked directly, you are certainly leaving money on the table. If you are getting calls from private equity investors, it is time to pause and assess the need to hire an investment banking advisory firm and a potential different legal team. Investing in quality advisors will pay off twofold. First, you will likely get a better deal, and second, you will save valuable personal time that you can dedicate to your practice and your family. Slide number 36 describes some of the documents that your legal team will negotiate on your behalf. These legal documents are very sophisticated, and you should not endeavor to just sign on the dotted line. Negotiating the terms of these documents will take a legal team comprised of, in most cases, mergers and acquisitions attorney or attorneys, a healthcare compliance attorney, tax and employee benefit attorney, an executive compensation specialist, and a real estate attorney. The careful analysis of a transaction legal structure will ensure that you get the best deal, including from a tax standpoint. In order to even have the opportunity to negotiate these terms, though, you should not sign a letter of intent or memorandum of understanding with a potential buyer without legal review. Because once you sign the letter of intent, although it may likely state that most of these terms are not binding, it will be very difficult to backpedal on such terms. An experienced legal team, as well as your investment banker, will know what's market and what's not. Please remember that although the buyers are ready to be your partners in the future, at the stage of the negotiation, they should not be considered your partners just yet. Private equity investors are very sophisticated parties. You need sophisticated advisors to defend your interests during the negotiations. As you contemplate this liquidity event, you should also review and potentially revise your estate planning documents, and if you are considering entering into marriage in the future, perhaps a prenuptial agreement. Some states, such as New York, for example, will also permit individuals to enter into post-nuptial agreements. As previously mentioned, slide number 37 describes the scope of engagement and the various aspects that your investment banking firm will conduct to prepare you for market, prepare marketing materials, and assist during the due diligence and closing process. Importantly, investment bankers and lawyers have distinct roles during the transaction. Objective data and feedback from private equity investors that we know clearly demonstrates that you will clearly benefit from using an investment advisory firm in addition to a strong legal team. This discussion about process considerations would not be complete without discussing fees. You should expect 3 types of fees: compensation for the investment banking advisory firm, compensation for the legal team, and compensation for the third-party entity that will conduct the quality of earnings audit. Investment bankers get remunerated through what is called a success fee. It is a percentage of a purchase price or a fixed fee. The success fee is designed to ensure that your investment banker gets you the best deal. In order to further incentivize the investment banking team, the use of a tiered approach can be negotiated. A bonus for multiples at or above a certain purchase price is also another way to incentivize your investment banker. The investment banker will typically charge a monthly fee that is credited towards the success fee. Expenses such as travel are invoiced on a pass-through basis. Although you should consider the success fee as an investment in your transaction and not a loss, we recommend that you first determine if the fee is market and, in the negative, negotiate down the percentage with the assistance of your legal counsel. Ultimately, the success fee has to be a win-win for both parties in order to incentivize the investment banking team. Your legal team will be able to tell you what's market. Your legal team will not be compensated based on a success fee. Although experience plays a role in the fees charged by legal counsel, the size of the firm you select has a major impact on these rates. The larger the firm, the higher the hourly rates will be on average. Moderate rates tend to be more available in the Midwest rather than the East or the West Coast. Your legal advisor should be able to provide a fairly detailed budget, including a high and a low range for the fees and for each of the steps of the process. This budget will largely be dictated by the number of documents as well as the length of the negotiations with the private equity fund. You should expect some overrun over the budget if the process encounters any difficulties during the due diligence process, or if you have not negotiated a lot of the terms upfront during the letter of intent process. This is yet another reason why you should invest time and resources in negotiating the letter of intent. All sophisticated buyers are going to demand a quality of earnings audit conducted by a third-party firm, not your own accounting firm. An average cost for quality of earnings is from $45,000 to $70,000 on average. As I just described, the cost of a transaction is not insignificant, but it is part of the process and you tend to get what you pay for. All deals are not created equal. The deal structure needs to be tailored to the specific situation in order to obtain the best deal and best tax structure for both buyers and sellers. An extensive review of all tax considerations and legal requirements is far beyond the scope of this presentation, but you should know about a few things at least. The structure of your deal will be specific to the type of legal entity that your practice currently is under, as well as the type of legal entity of potential other practices you are trying to bring together during this deal. The tax attorneys involved in the deal will ensure that you derive the best tax structure for you and your partners. Depending on your specialty, as well as the risk appetite of the buyers, you may either encounter an asset deal or a stock deal. During an asset deal, the buyer will only acquire your assets and only assume specific liabilities to be negotiated. On the other hand, during a stock deal, the buyer will acquire assets and liabilities because it will be buying the stock of your business entity, not just handpicking specific assets and liabilities. The sale or merger of a practice implicates multiple federal, state, and local level laws and regulations. One of the most important ones applicable to physicians is the Stark Law, one of the anti-referral statutes. Although numerous services provided by vision care specialists such as yourself do not implicate the Stark Law, several do, including imaging. All legal professionals as well as the government agree that the Stark Law in its current form is an overcomplicated and difficult to administer legal burden on all providers and the system overall. Although efforts to repudiate or revise the law have been set in motion by the Trump administration, we are not there yet, and the law still applies to the current deals. Your legal advisors will ensure that your corporate structure continues to satisfy all the elements of the group practice and the in-office ancillary services exceptions before and after the deal. The purpose of slide number 42 is to list a number of doctrines, statutes, agencies, both at the federal and state level, that will be implicated during the sale of a practice. Your legal advisors will take care of these and ensure compliance at all levels. What is important for you to grasp is that these legal compliance requirements will affect the corporate and tax structure of the deal. The number of options and permutations permitted based on these requirements is limited, and only a team with experience in these types of transactions is equipped to advise you across these risk-laden waters.
Beginning on slide 43, we'll look at how transactions are structured by private equity groups. I'll jump around a little bit on the next few slides, but be sure to call out the specific slide I'm speaking to so you know where I'm at. And I'll actually begin the discussion on slide 44, where we look at an illustrative transaction structure common to many private equity deals. You'll note that these transaction structures provide physicians with some liquidity up front, but also give them a second bite of the apple, meaning that they own equity in the business, and at the time of the next sale by the private equity group, they would be able to sell that equity, second bite of the apple, and in many cases recognize a significant return on that initial role or investment in the practice going forward. It's also a great mechanism to make sure that incentives are aligned between physicians selling the practice and private equity group. Everyone is going to show up to work and work hard every day and grow the business. So I'll walk through the diagram entitled Illustrative Sources and Uses here. Really what that refers to is how the deal gets funded and who gets what in terms of dollars at the time a transaction closes. On the next slide, we'll look at how those numbers change over time and what physicians could expect at the time of a second sale. But for right now, let's look through that first transaction. And in the example here, we have assumed that a practice is going to sell for $100 million or 10 times $10 million in EBITDA. And the way a private equity group is going to pay for that is they're going to go out and borrow $40 million. The term in the form of term and mezzanine debt. They're going to contribute $43 million of their own equity, and they'll ask physicians to roll over a portion of the proceeds that they might receive, in this case, $20 million, or roughly 20%. That's a good rule of thumb. Most private equity groups, unless there are extenuating circumstances, will want selling physicians to roll some equity into the new business being formed, because it will help align incentives and because they want them to benefit from the growth that everyone will recognize in the investment. You'll note that these sources are often quoted as a multiple of EBITDA, term we've discussed already, and correspond to a percentage of sources, and can help us determine the pro forma ownership of the business. So let's start with rolled equity first. Again, this is equity retained by the current partners post-transaction. And in the case of this example, that rolled equity is, again, right around 20%. Notably, through the use of debt, that 20%, or $20 million of equity, ends up being a lot more in terms of the pro forma ownership percentage going forward because of private equity's use of debt. And the quick math there is to divide the $20 million the physicians contribute to the sources by the total dollars put in, which would be their $20 million plus private equity's $43 million, $63 million is the denominator, ends up with physicians rolling 20% and ending up owning close to 32% of the business on a go-forward basis because of that use of debt. The uses on the right-hand side of that graphic just speak to how dollars are allocated at the time of close. So again, selling physicians, selling their practice for $100 million, they'll receive $80 million cash up front, gross taxes, and then rolled equity, which will be a $20 million stake in the go-forward business, as well as any ancillary cost used to complete the transaction. So things here to note: thoughtful use of debt benefits you, the sellers, in that your rolled equity is worth more. And we'll see on the next slide, moving to slide 45, how the value of that rolled equity can grow over time. So again, looking to structure a deal not only to provide upfront liquidity, but also a second bite of the apple. So post-transaction, what happens? So over time, private equity will pay down that debt, potentially create an options pool, and as the practice continues to perform, the profits will be used to service and reduce that debt. Reducing that debt is going to increase the value of all shareholders' equity, including the selling physician. Sometimes they'll create an options pool, again here to attract and reward key providers. As part of the model, as we've talked about, really thinking about the second bite of the apple. And assuming debt has been paid down and the practice has grown, that second bite of the apple can be meaningful income for the equity owners. So we've put together an illustrative example here. So let's say in the prior slide, we assumed EBITDA was 10 million. At the time of sale, 5 years from now, that EBITDA has grown to 30 million. In addition to having significantly more EBITDA, you would expect a higher multiple or higher valuation for the business. And I'll go back to our conversation on scale and how that drives value. And you can see that, because of an increase in size, your expected valuation would be higher than it would, if you remained a smaller company. So time of sale, quick math, 12 times 30 gets you roughly $360 million in enterprise or equity value. And your equity ownership, well, it may have been diluted over time through additional acquisitions or the creation of an options pool, is worth significantly more. So we've assumed modest dilution of the equity ownership over time. That 21% ownership at the time of the second sale could be worth, in this example, $76 million in partner equity. And over a 5-year period, you would have generated close to a 4 times cash return or close to a 30% return on the investment. It's hard to look at the market and generate those sorts of returns, and you can see just how valuable that second bite of the apple can be. I'll pivot back quickly now to slide 43, which discusses how the legal structures work. So initially, Dr. A or partners in practice A are going to own 100% of the equity in their practice. Private equity will not own any equity in practice A, but can set up various legal entities that would allow them to indirectly invest in practice A in a manner that's consistent with corporate practice of medicine. So remember slide 43. We'll then pivot to slide 46, post-transaction. So after the deal is done, Dr. A will continue to own practice A to be compliant with corporate practice of medicine. There will also be a new entity created by the private equity fund, an MSO. And between that MSO and practice, in this example, there'll be a services agreement, which obligates practice A to remit a portion of collections for management services. And through this structure, the private equity would be able to, in a compliant way, capture the cash flows of practice A through the managed service organization without directly investing in practice A. It's a very common structure, one that we've seen on just about every one of the physician practice management deals that we've worked on. But for more questions, I would encourage you to reach out to Isabelle, who has a wealth of experience navigating and setting up these structures to be efficient, compliant, and in many cases tax advantaged for the selling physicians. Moving on to slide 47 and departing from our discussion of transaction structures, I want to highlight some key seller criteria. We've touched on a lot of these topics through the slides already, but as we near the end of the presentation, really want to provide a consolidated view on the things you should be thinking about as a seller here in relation to the transaction. So again, think about tax considerations versus total transaction value. The dollars you can pull forward today are typically done at a capital gains rate, whereas future comp is likely to be taxed at ordinary income rate. So there is an advantage to pulling dollars out of the practice through part of a sale. Think about where the capital is coming, right? And again, this deals with your tolerance for risk and your desire to select a partner that is most likely to get a deal done. So do they have access to the money? It's very common for serious groups when submitting a letter of intent to purchase your group to provide a summary of a credit letter indicating that they've already prearranged financing for a deal. Think about the transaction structure. How much cash would you like to pull out? How much equity would you like to roll? Again, there's no hard and fast rule here. We used 20% in the example a few slides ago. Private equity could get comfortable with you rolling as little as 10 in some cases, and would be happy to have you roll more. The more skin in the game you have, the more committed you'll be as a partner, and the potentially better returns a private equity group can underwrite. Again, think about what your personal and the practice's financial goals are when determining how much cash to take in the form of consideration versus rolled equity. Think about governance. Think about who's going to make decisions for the business. Again, this harkens back to our discussion of platform versus add-on, but important questions to ask. Again, in our discussion of private equity, we talked about what other resources they might bring to the table. Is it expertise, setting up an ASC or developing joint ventures with local health systems? Do they have relationships with commercial payers that they can help to negotiate better rates? Think about what they can do to drive operational improvement. Think about the autonomy or the partnership style that they have, as well as their track record. A good advisor will help you ask those questions and many others as you form an opinion on whom the ideal partner might be and what the best structure could be for you and your partners. Moving on to slide 48, and just rounding out our discussion of buyer criteria, think about or ask questions about how they've performed in the past with previous investments in specialty physician practices. Think about how you can position your business to complement what they've done from an operational perspective or those capabilities that they bring. Now, buyers will want you to also prove out your financials. So in the case, and this is pretty common for specialty physician groups, they'll perform a quality of earnings review as part of their diligence efforts. They will hire a third-party accounting group, usually a name that you've heard of, to go through and prove out your earnings. We'll help you through that. A best practice these days is to do a sell-side quality of earnings review prior to kicking a deal off, just so that the numbers that you'd put in the marketing materials are clean and clear, and have identified any gotchas long before private equity goes through that exercise. Think about the key providers on your staff and what you could do to retain them. Make sure you have upfront and honest conversations with your team about your desire to partner with the private equity group. Think about ancillary opportunities that you could do. Again, to position your practice in the best possible way. These are things that buyers are going to be looking at as well. To the extent that you can, show growth in your staff over time. It's really important to articulate your recruiting pipeline, particularly for sought after specialties like ophthalmology and subspecialties like retina. There just is a lack of providers. Scarcity creates demand. You can play that up as buyers evaluate what is key to them from a company or investment profile. Buyers are going to be very keen to understand your compliance efforts, as well as what your referral and patient patterns look like. So be able to, track that data down and present it in a clear way. Doing so can create a significant amount of value in your process. I've touched on, and I'm moving on to slide 49 now, a number of the items that buyers will diligence in a transaction, and I certainly won't read all of them here. A good provider or partner, be it legal or financial, will help you think through each of these items well before you get to diligence. We've gone through key documents, flagged areas where there could be concern or required to be positioned a certain way. And here it just behooves you to know what buyers will be looking for, get out in front of them so that you're putting your best foot forward. Moving on to slide 50, I'll just highlight some of the more important items, particularly around billing, coding, and compliance. And much like financial diligence, private equity partners will often commission a third-party billing, coding, and compliance review, whereby they will sample select a number of CPT codes for the last few years, look at what was billed for those codes, as well as the supporting documentation behind that billing to just assess the coding and billing practices of the practice. I'll look for overpayments, look for concentration in terms of any one practice area, and just make sure that you've got good processes and procedures for documenting the work that you're doing for your patients. Moving on to slide 51, in addition to financial industry-specific diligence, there will be a handful of key legal and compliance issues that are worth spending time thinking about. And many of your practices will already have a healthcare regulatory law firm that you're working with to make sure that you've developed the right procedures to deal with stark HIPAA related privacy laws, and make sure that you are executing to a strong compliance plan. Again, I won't read through each of these items, but leave them here as a checklist for you as you think about preparing for a potential transaction. And finally, in this section, I'll note one of the important things to negotiate is part of the sale of the practice, strong employment agreements for providers going forward. Again, this is an area where there is a fair amount of latitude to negotiate for providers and key personnel. I think it's reasonable to expect these employment agreements to last anywhere from 3 to 5 years. It's notable that some states like California and Massachusetts may have laws in place that make employment agreements difficult to enforce, but there are other ways that you might get tied up in the purchase agreement. So a good thing to think about with Isabelle or counsel as you're negotiating the sale of the business as well as your purchase agreement. Think about termination and what the potential effects of termination can be and how those are memorialized in your employment agreement. A tail coverage for your insurance policies, compensation. We've talked a lot about this already in terms of how it may impact financials and what amount of EBITDA that you're able to sell down. But regardless, it's a personal choice. It's something you need to be comfortable with. So give some thought to this and, really know what you need to be making in order to feel comfortable and excited to show up to work and work hard after the sale. Non-competes, again, are geographic in scope and practice type. There are various state laws that you should be thinking about in terms of their enforceability, but a good counsel can help you think through that, as well as confidentiality, poaching, and interference concerns. So I'll wrap things up by thanking you for your time. It's been great to share some insights we have on the market and how these partnerships come together with private equity. And we'll look forward to hearing from some of you as questions come up. Please feel free to reach out. We're here to help.
Before we part, we want to share some last words of wisdom based on our collective experience. The following recommendations may appear very simple, but if you follow them, Patrick and I can guarantee you that they will make your process a lot smoother and therefore a lot more cost-effective. First, It is very important that you have a consensus with your partners before you engage into any material discussions with potential buyers. Any dissent among the partners will either scare potential buyers or drive your return on investment down through a multitude of fashions beyond the scope of this presentation. You should refrain from sharing any proprietary or confidential information with anyone without a solid non-disclosure agreement. Your standard non-disclosure agreement is not fitted for this type of process. You need a specialized document. Our third advice is to determine in advance who will be privy to these important conversations and at which stage. Although we recommend involving as few people as possible, you do need some help. Your accounting firm will be a key partner, but you need to usually recruit the assistance of your practice manager. A bonus is customary in order to keep him or her motivated and to account for the extra workload. Certain protocols, such as the use of a code name for the project, will assist in preserving confidentiality. Our fifth advice is to avoid any exclusive dealing without advice from counsel or an investment banker. Your management team is most likely not equipped to deal with the sophistication of a private equity fund. In addition to leaving money on the table, you will likely not be able to negotiate the best terms, including with regards to non-compete covenants. This principle also applies to the letter of intent. You should negotiate a robust letter of intent with as much detail as possible. We urge you not to just focus on the multiple or the monetary offer. Your employment terms are especially important. Most of us think that we are way too young to think about succession planning, aren't we? But the data, especially during this pandemic, does not support this proposition. Succession planning and thoughtful recruitment can only drive up the value of your practice. Lastly, please do not overlook domestic relations and estate planning considerations regardless of your age and situation. And voila! Patrick and I thank you warmly for your attention. We would like to point out that this slide deck contains some exhibits after the disclosure slides that follow. The exhibits contain metrics about prior transactions, some general thoughts and additional words of wisdom, best practices to conduct an effective transaction process and how to best prepare to go to market, tax considerations between a stock deal and an asset deal, as well as a sample due diligence checklist so that you may assess the scope of that task. It is time to say au revoir. We do not take you or any of our existing clients for granted and are truly thankful to have had the opportunity to introduce ourselves today to demonstrate our experience and what sets us apart from other providers. If you have any follow-up questions, please do not hesitate to reach out. Our contact information is at the beginning of the presentation. Thank you for your consideration and merci beaucoup.